DEXs used to be like the most popular product by TBL, and now it's been lending. And I think that's because a lot of liquidity moves to where the risk is lowest. And because it's been so high risk to participate, especially with how concentrated liquidity has evolved, it's been hard to match that liquidity with the demand for these tokens.
You don't really have a major alternative to risk assets right now, and it doesn't seem like any of that is going to change soon.
You don't have a liquidation price, you have a time to liquidation, because we don't use an oracle, so you can support any token, but the product is just based on the supply of the two assets, so it doesn't actually depend on the price.
Has GammaSwap actually solved impermanent loss?
I would say we kind of have, but I think if you are saying it's completely removed, I would say that's probably impossible. But what I think we give people options on how to remove that risk, kind of like buying insurance.
The main complexity lies in the fact that it's a non-linear change in collateral and in P&L, right? It is not like a 1x, 2x, 3x, whatever levered linear position where you just have to hedge a delta, but it changes exponentially depending on the ratio in price change of the two assets in a pool. Welcome back, everybody, to the Odyssey Believe in Something podcast. Today we are joined by DeFi Devin from GammaSwap. Hi, Devin. How are you doing?
Doing great. Yeah, thank you for having me. Really excited to talk more about I guess some advanced DeFi concepts and the GammaSwap protocol a little bit more.
Great having you on. So has GammaSwap actually solved impermanent loss? Is impermanent loss still an issue and a challenge to think about as a liquidity provider in DeFi?
Yeah, I think it's an interesting question because I would say we kind of have, but I think it also depends how you solve it. So if you are saying it's completely removed, I would say that's probably impossible, and we haven't done that. But what I think we've done that helps benefit the space is we give people options on how to remove that risk, kind of like buying insurance. So giving people that option to maybe pay a little bit more, and they get a little bit lower yield, but it's a lower risk yield. And we also have that option where people can do that themselves. And now we've just created this automated product that does that for users. But I think that's been, DEXs used to be like the most popular product by TBL, and now it's been lending. And I think that's because a lot of liquidity moves to where the risk is lowest, and a lot of yields and AMMs have been really high, and on-chain liquidity is super high to power like liquidations on Aave, different types of DeFi protocols and contracts. But because it's been so high risk to participate, especially with how concentrated liquidity has evolved, it's been hard to match that liquidity with the demand for these tokens. So I think that's one interesting aspect of GammaSwap is we can help de-risk that depending on how advanced the user is and give people options to reduce that risk.
Yeah, I mean, you can ask the question whether you have to solve for impermanent loss anyway. Like some people don't even view it as a problem, but maybe to start bottom up, how did the idea of GammaSwap originally emerge? What kind of issues were you identifying in the liquidity provisioning space around Uniswap, SushiSwap back in the days, and how did everything develop from there?
Yeah, so there's three co-founders. I'm one of the co-founders, mostly responsible for growth and marketing. The first co-founder was the inventor, and his background was he had been a quant at Wall Street, worked at Oppenheimer, Goldman, and then at UBS, I think for about 4 years, and left in 2016 to trade his own strategy. So was doing some market making on Coinbase and then some stuff on chain, but there wasn't really much back then until Uniswap v2 came out and SushiSwap, and yield farming became this huge thing, and the yields were massive. So he was providing a lot of liquidity, and then once those yields compressed from the incentives, he realized, a lot of these pools actually aren't that profitable to provide liquidity in. So he was using Aave to help reduce some of that delta exposure, but still there was still some impermanent loss even with that strategy. Wouldn't support all the tokens because of the LTVs and the price-based liquidation risk. It also wasn't the most capital efficient. And so as a trader, he actually just was like, oh, if I could build something to short this, it'd be pretty profitable. But then realized some of like the implications of it being a great hedging strategy, potentially increasing liquidity in these AMMs and things like that. So he had started writing about it and working on the smart contracts, I would say, end of 2021 into mid 2022. Then there was a hackathon, ActivateX Wormhole, where I was previously at an infrastructure company called Figment that does a lot of validators for proof of stake blockchains. And so it was more institutional, but we were uh, looking to create some products for developers. So we were helping judge this hackathon. And I had provided liquidity in AMMs, and I would get quoted a high yield and would end up unprofitable. So when I saw GammaSwap come around, I thought there was something interesting there. And so I originally wanted to invest, and then was just really impressed with the team and the product. So wanted to join and got the opportunity shortly after. And then our third co-founder was previously a software engineer at Meta and does a lot of our front end and design. So got a chance to cover all three of the spaces, but that's how it started out. So we've all been full time on it mid 2022. The first version of the contracts, the current version of the contracts launched 2024, and then we just released this new Vault product that automates CIL hedging for users. So we describe it as like an Athena basis trade, but for AMM liquidity. So you get these like tokens, these synthetic tokens that replicate spot, but earn a yield over time, and it hedges out that IL risk for users.
So addressing impermanent loss, either to completely hedge it or to just mitigate certain parts of it, this topic has been around the DeFi space ever since people became really aware of like the mechanics of liquidity provisioning during the DeFi summer 2020 and then the big run up in 2021. So what have you guys improved upon versus prior solution attempts, and what did your initial product look like, and what were the basic mechanics of it?
Yeah, I think it's a good question. It's just honestly a really difficult problem to solve, and there's pros and cons, I think, to different approaches that people have attempted. I think we're confident in our approach, but yeah, each approach has its pros and cons and can make it difficult. So I think like one of the first attempts of this was like Squeeze with their power perpetuals. But I think, one thing about not using like a typical kind of like AMM or using some Oracle or using some virtual liquidity is that it's hard to exactly align those returns with your impermanent loss risk. And yeah, I think they went on to create new products and then ended up getting acquired by Coinbase. So yeah, I guess they're no longer working on this, but I think that was some of the issues with their first attempt. And then, yeah, I guess after that, there's no specific project come to mind. I think people have toyed with different ideas. Oh well, there's some projects. So let me describe how GammaSwap does this, and then there are other projects that do it in a different way currently. And I think there's pros and cons to each. So what we do is we have full range AMM pools, so constant product market maker pools, and this is where it becomes difficult because even we got ideas for things as we started building this out, but the first version of the protocol would just be borrow what we say is that providing liquidity to take a step back in a full range AMM is like selling a perpetual straddle because, yeah, you are basically short volatility. And if there isn't much volatility, you'll make a profit and you're earning kind of like this premium, but instead of it being fixed and upfront, it's earned over time. And it's similar to the risk you would take selling a straddle. And then if you borrow
Well, just
that,
for the people who are not fully aware of options. So a straddle, if I remember it correctly from my college days, is when you sell both a put and a call option. So essentially you're locking in a premium that the option buyer pays, and you lose out if there's volatility that is high, and you win if volatility stays low, right?
exactly, yeah. So you would sell a call and a put with the same strike price and then with the same expiration date. So it would be like selling a call and a put with the current price being the strike price, and then the expiration date being perpetual, never essentially. And so that's like pretty much the exposure you have. So if you think about it, you're selling a call and a put, you're basically neither long or short. You're just hoping that there isn't much volatility where you would have to take a loss on either of those positions, and you're just collecting fees. And so that's very similar to what providing liquidity is like, but there hasn't been a way to get that long volatility exposure. And so we realized, okay, if we let people borrow liquidity from this, and how we do it is we essentially burn the LP position. We hold on, let's say it's an ETH USDC pool, we hold on to the ETH and USDC collateral. And then if there's a permanent loss, that LP position is worth less. So you can remint it and keep the difference. And then the fees you pay to keep that loan or that long volatility position open is the swap fees the LP position would have accrued, plus additional fees based on utilization. And yeah, that's one of the reasons we used a full range pool, because all of that was easier to track, and then all the liquidity was fungible as well. But yeah, it's not as expressive, I would say. But what we realized is that we could actually change the collateral balance to replicate different types of kind of like, well, exposures. So instead of it just being purely 50-50, we could have it weighted one way or another. And that way it helps you hedge the impermanent loss in Uniswap v3, where the rebalancing is more one-sided. If you go out of range, you're either fully in one token or the other, and the exposure looks kind of like more like a call or a put. It's very weighted towards one side. And so that's what we did. So we allow people to open longer shorts that were balanced, for example, in a long, some of that USDC and ETH. So you're mostly in ETH, or in a short, mostly in USDC. And if we combine that with a Uniswap v3 LP position, we can replicate one of those tokens, ETH or USDC, similar to spot exposure, but earning a yield without the IL risk. And so that's what we've been writing about, and that was like the product we just launched that does that for users. But yeah, I would say that's the approach we've taken, and so it might not be as expressive maybe as some other approaches, but I think the reason it works well is that all the liquidity is fungible, like a typical lending market. So we can treat all those positions the same. There have been other approaches where you would actually borrow from a Uniswap v3 pool and short the LP that way, which can give you more, I'd say, like varied types of exposure. But I think the problem is that like weird things can kind of happen. It's kind of difficult to manage. One, the math is really complex. Two, for example, if you go fully into one token or the other, your option position kind of like is liquidated or expired because it's no longer balancing at all. And yeah, if people want to open a position with a certain range and no one's LPing in that range, it just fragments the liquidity. So that's an approach some other projects have taken, and I think it has some advantages, but it also has some things about that approach that make it difficult. So this is the approach we've taken, and it's been working well for us so far. But I think that's been the difficult thing, is just it's super complex. There's so many different approaches you could take, and they all have their own merits and their own issues.
Yeah, I think the main complexity lies in the fact that it's a non-linear change in collateral and in P&L, right? It is not
Right.
like a 1x, 2x, 3x, whatever levered linear position where you just have to hedge a delta, but it
Yeah.
changes exponentially depending on the ratio in price change of the two assets in a pool. So when you
The delta is changing. That's the hard part. Yeah.
when you go onto the GammaSwap site right now into the application, there are a bunch of different products offered. So first of all, you have the perp options. I think that is what we just covered, right? Then there is, on the earn side of things, there's both a pool and yields token. So could you dive a little deeper into how these work and what they resemble?
Yeah, great question. So I think I covered it a little bit, but I'll cover it more in depth or be more specific. So the pools or full range AMM pools. We call them gamma pools. They could be our own AMM, which is Delta Swap, which replicates UniV2 exposure, but it could also be something like Aerodrome V1, which we're working on integrating right now, or something like Uniswap V2. We wrap that, and when people open a perp option position, we essentially burn that LP, keep the collateral in the smart contract, and let people take the opposite exposure. So you have to put up some collateral for that. It could be in a straddle, long or short. So you don't have a liquidation price. You have a time to liquidation because, yeah, we don't use an oracle, so you can support any token. And because I guess this is kind of another technical part, but we price the debt in the x times y equals k formula. So for those who aren't familiar, that's what calculates the constant product in the AMM. So it handles like how the supply of the tokens should be rebalanced to always equal that product. But the product is just based on the supply of the two assets. So it doesn't actually depend on the price. And that's why we don't have a liquidation price. Instead, it's a time to liquidation, so it measures how long it's going to take before you hit your LTV based on the fees you're paying. And it could be in a straddle or it could be a long or short, which kind of looks more like a call or a put, where we've rebalanced tokens to be in a different ratio. And that's positions you could open yourself, either to speculate on volatility or to hedge impermanent loss by yourself. We have an academy that has lots of spreadsheets for you to, if you want to go into an LP position based on a certain range, how to hedge that, full range, etc. But of course, there is some liquidation risk you have to manage. If your LP position goes out of range, you would have to rebalance the position and the hedge. And so it's not realistic for maybe like the average passive retail user. So we've also created these, what we call them yield tokens, that automate this for users. So they'll provide liquidity into Uniswap V3, use GammaSwap perpetual options to hedge the IL, and then provides basically like synthetic spot exposure. The first one being ETH, based on the ETH USDC pool, to that user. So it earns a yield over time and replicates ETH. And yeah, it's been going really well. When we launched it, we thought we were confident that it would do well, but we were surprised by the demand. So it hit vault caps every day, hit the total cap, and then people kept like waiting to deposit more. We actually had to pause deposits on it. So right now we're creating some dynamic fees so that people can scale into it as they see fit, and then also working on releasing more yield tokens like GBTC and GUSC.
So if you deposit into GETH, and just to clarify if I understood it correctly, it essentially tries not to replicate ETH USDC position, but just hedges IL. It just aims to track the price of ETH. So ideally, the yield you get is comparable to just supplying ETH in a lending market, for example. So the underlying exposure is just being delta long ETH, right?
Yeah, so yeah, this is I think where some of the complexity comes in. It's delta neutral in ETH terms, so it's replicating ETH, but there is a little bit of gamma exposure. So if you go, for example, out of range, if the price goes out of range and it has to rebalance, you'll realize like a max drawdown of 1 to 3%, depending on the range. So it's still, I would say, like a mean reverting strategy. Although we've back tested the strategy over like 3 to 5 years, and I would say like if the yield is 20%, the performance would be 15%, for example, so like 75% based on the drawdowns. So yeah, it's still a high performing strategy, but it's probably not as low risk as just providing ETH into lending market. It's but it's replicating that ETH exposure with a small potential for a drawdown, depending on if it goes out of range. And there's some rebalancing cost that has to happen, and then a little bit of cost that is realized from that loss.
So in terms of ETH price action, ETH right now is sitting at around 4,300 the time of his recording. So just to think this through, I'm depositing a couple of ETH in the GETH vault. What happens to my ETH yield returns depending on what happens with ETH price action? Just to kind of exemplify these outlier events that could either amplify or dampen the yields paid out.
Yeah, so I would say, for example, in this case, the price, I think the range started at 3,600, and then we're starting wide to be more conservative, and then we can tighten the range like over time. But right now it's plus or minus 50%. So it's still within range. We're going to rebalance before the contracts are set up to rebalance before it gets fully out of range, because that's going to incur less loss. And so right now, I think the drawdown's been around 0.5%, and the yields been anywhere from like 15 to 30%. So with that drawdown, that would take about like 2 to 3 weeks for it to pay back for. And then, yeah, if it mean reverts before the range rebalances, then you would be up maybe like a percent or two. If it would go, I guess the plus 50 of, I think it was like 3,600 where the range started. So 5,400, if it approached that range, then you would realize maybe somewhere the vault would realize maybe a loss of like 2% in that case. 3% is if it goes down. So yeah, that's essentially the risk that you're taking. So I think if you're only, if there's like, if the market's trending really strongly and you only want to be in this position for like a month or two, then it might not make a ton of sense. But if you're willing to stay a little bit longer, given that it's been at least just based on back testing, which you know it's different than real life. But if you're willing to stay in longer and stack ETH, then it's probably a good strategy. Or yeah, if you think the market's gonna be pretty like relatively stable, then it's a good strategy. But yeah, like that's I would say something to be cautious of on short time frames with a trending market. That's where the high yield might not make up for the drawdown.
So at the end of the day, you're still selling volatility to some extent. Maybe not directly, but you would get harmed by outlier volatility events, right?
Well, yeah, that's the thing too, is that we've hedged it to be delta neutral. We could hedge it to be gamma neutral and perfectly hedged, but the yields are going to compress significantly. And then even if we are gamma neutral, it's still not like a 0% drawdown, because if it goes out of range, you're still incurring like rebalancing and slippage costs. So this was the delta neutral but not gamma neutral was what showed the strongest performance. And then yeah, what we could do, for example, we've had like different ideas on what would make the most sense for an integration is like maybe we pair a GETH from ETH USDC and a GETH from ETH BTC, so into like an index. So then you have maybe like a similar yield but less chance of a drawdown on it, so it would make even more sense for looping. Even with that small drawdown percent, I think there's definitely like certain looping strategies that make sense, just maybe not as high leverage, and integrations into like other protocols as well. But yeah, that's what I would say is that just based on like historical market is that yeah, everything kind of goes up on a long enough time frame. But I would say it usually like things don't spike up like 50% in a day. I think like the most ETH has spiked up was like 20% in a day. And then usually partially mean reverts. So this type of strategy has what's been proven to be like the most profitable for the risk, the highest sharp type of strategy.
So just to ask the obligatory question to every DeFi protocol, where is the yield actually coming from?
Yeah, so the
Especially for
yields
the GETH vault right now.
so the yields coming from Uniswap v3. And then what we've done some unique things to make it more efficient. So for example, we share fees with the pool, so the yield wouldn't go negative, for example. We use the LP position as collateral for our loans to make it a little more capital efficient. But the the high level is that yeah, it just gets yield from Uniswap v3 that's hedged, so it's going to be a little bit less than Uni v3, but you have a significantly less risk within the range. And if you go outside the range, since the delta is hedged within range.
How does the Gamma token play into this?
Yeah, so the GS token earns 30% of all protocol revenue via staking, and then we also pass on some rewards, some escrow token rewards to stakers as well as liquidity providers. And then, yeah, as we build more revenue, we plan to share a higher percent. Right now, we just want to, yeah, build up the treasury. And then also, we do need a couple more engineers that we're currently hiring for right now. So there's been a lot of demand for this product. So want to make sure we can cover that and then increase the revenue. But essentially, yeah, like a percentage of the revenue that you would earn.
What's the plan to scaling GammaSwap? Do you aim for any composability integrations with other DeFi protocols so people can directly access your products through another applications, or how do you intend to grow it?
Yeah, I think we wanted to start off with integrations right off the bat, but the demand has been really high, so we just want to put in so in place some I would say like slight upgrades just to price that risk better, and then work on basically pursue these integrations. So some of the integrations we've been that we would think would be useful to users are, for example, like Pendle. So Uniswap v3, the yield is extremely volatile. So one moment it could be, for example, on the yield token 15%, and then we've seen as high as like 50%. So you might want to go in when it's 50% and lock in that fixed yield. Like that could be a great opportunity. Or maybe you think DEX volumes are going to increase. So it'd be a way for you to speculate with leverage on DEX volumes. Get a different type of leverage that way. Looping, of course, with like Morpho and Euler, I think could make a lot of sense. And yeah, those are kind of like the integrations we had in mind initially. So just planning on figuring out how to price that risk so we can increase the capacity a little bit and then launching those integrations. If there's any others that people have in mind, like let us know. But those were the two primary ones, like lending and then yield trading.
Are there inherent limits to scaling these strategies you're currently employing? Like to what extent would the yield get diluted? And maybe that also explains the current cap limits that are on the balls.
Yeah, so there are some limits to this strategy. So right now, a big limit is, I would say, how much liquidity we need to hedge. So since we're using full range constant product pools to hedge, and UniV3 is leveraged, it's like essentially leveraged UniV2, depending on the range. We need more liquidity in the pools to hedge the yield token. So right now we're starting with the safest strategy possible, and we're using 3x leverage with a wide range. We think as more time comes, we could lower that leverage ratio and then also tighten the range, maybe using some intents and then rebalance more frequently and make everything more capital efficient. But it'll always at least need 1-to-1 in the liquidity pool that it's using to hedge uh, to support that TBL. And then there's other ideas we had to potentially scale it, but I think that's the first thing we're gonna do is just make those that hedging more capital efficient. And then yeah, I think with a depends on, I guess, the risks you're comfortable taking, but this V1 has some pros and cons. So one pro is that it's Oracle free, so we could technically create a yield token on anything. It's just, maybe for some low caps that wouldn't make a ton of sense. So we want to do large caps and mid caps, and then I also think there's going to be opportunities in the future to keep growing V1 if like new, for example, with new token launches. But with the V2, if we were to use an Oracle, we could kind of like how Boros is right now, where like I think they have like 80, like 90 Bitcoin in open interest, but only like half a Bitcoin in the vault using like UniV2 style like pools. That would essentially be something that could be similar to our V2. We could use a UniV2 pool or maybe even like a yield token, depending on how we design it. And then yeah, because leverage would be higher, we wouldn't need nearly as much liquidity to hedge that risk out or to provide leverage to traders. So that would be the V2, but because it uses an Oracle, it would be limited on the assets. I think a lot of people are mostly interested in the large caps, but there's always like a new coin that people are interested in, or also sometimes like higher yield opportunities with the new pools. So we're trying to get as much juice out of V1 as we can. And then if we feel like we are hitting the scaling limits and there's nothing we can really do to maximize efficiency, that's when we'll work on the V2 that would be more capital efficient.
Yeah, I definitely see the point that if we want to get crypto more mainstream and get institutional and large players not only use blockchain infrastructure for their own products, but also interact on our ecosystems, I think there are a couple of things that have to be improved about liquidity provision, both in terms of depth of liquidity, so concentration around the current price, and then also the landscape of hedging instruments surrounding that, because the like for a large player, I think the liquidity yields right now are still too unpredictable and not really worth the risk. And on the other hand, the lack of depth of liquidity scares away a lot of large players. I mean, in some of the yield syndicates where I am active, it is still quite a common issue or a common question that if you want to move around size, and size in the case of some DeFi chains and protocols only being like a small to mid 5-digit amount of money, which is pretty much nothing in the TradFi world. Like, people are already running into liquidity constraints when it comes to these small numbers. So yeah, I think the landscape of instruments and tools around LPing has to drastically improve to really get this place adopted for larger players, especially around the AMM space. I mean, if we are talking about central limit order books, it's of course a different question, because you can manage liquidity there in a lot of different ways. I think also when you talked about Pendle, it would be interesting to have interest rate derivatives on the like yield swaps on liquidity positions, so where you can speculate on the returns of these LPs going up or down. That would certainly be an interesting product. I don't know how easy it would be to execute that, because you'd kind of have to make these positions fungible and standardized. And I think in terms of concentrated liquidity positions, that is quite difficult to do. But
Well,
yeah,
that's one advantage I think we have is that our pools are full range, and so they're fungible. But a lot of people don't really like using those integrations, which I think their reasons make sense. Is that the IL risk makes liquidations unpredictable, and then I think Pendle works a lot better if the asset is relatively stable that you're speculating on, whether it's a stable coin or something like ETH. If it's varying a lot, it's much harder to trade the yield of course. So the yield tokens are relatively stable, much more stable than something like a liquidity position, pretty close to synthetic, but pretty close to like spot ETH exposure. And then all those tokens, the receipt tokens are ERC20 tokens. So they're completely fungible and can be treated fully. So I think that's like one underlooked aspect, I guess, is that concentrated liquidity has a lot of advantages in capital efficiency, but one of the reasons people love DNV2 and it became so popular was that fungibility aspect. And fungibility is important in terms of, well, increasing a different type of capital efficiency. I think there's the capital efficiency of how useful that liquidity is, and then there's capital efficiency of how many times can I rehypothecate this asset. And so that's one thing I think that's interesting about the yield tokens is it allows people to do those things and be completely fungible.
to the active yield formers in our audience, to what current products would you like to guide them? And is there anything you can tease what is coming to GammaSwap in the near future?
Yeah, great question. So I think there's one integration that's pretty interesting that there's this arm of Delta Prime called Degen Prime that's working on one-click kind of IL hedging solutions. So you wouldn't have to necessarily calculate all these values yourself, and it saves you a lot of the work in setting this up. So I think that's probably something interesting for maybe some of the advanced farmers who might not have as much time or just want an easier way to interact with the protocol. That should be coming relatively soon. And then Yeah, some of the things I touched on before is just releasing um, more types of yield tokens. Right now, we're trying to get more liquidity to hedge the yield tokens and scale that out. So we have some high incentives to kick that off. We call it GammaSwap Summer, but it's essentially a period of increased rewards in our escrow GS token. So it's like GS with a 30-day vest. Um, and yeah, that's most of the opportunities right now. Um, that's where our main focus is, just creating more strategies that are more capital efficient with these yield tokens.
Very nice. So what's your current composition of users? Are you working together with a lot of liquid funds and some more like crypto native institutions? Is it mostly retail? How's the user base composed?
Yeah, it's a good question. I think there's been some funds that I think I guess something that surprised me a little bit when I first came into this. When I first came into it, I assumed this would be like a product that a lot of funds would primarily want to use. And it makes sense now that I look back, but I think the interest from like institutions has increased with retail interest because there's more liquidity to trade with. So I think they've kind of been like hand in hand. Maybe like 80 and 90% has been retail interest, and then like 10% or I guess like retail and whales, and then like 10% has been like institutional funds. But as we've gotten more interest from retail, there's been more interest from institutions. So um, yeah, what I've kind of heard from other protocols is that like at certain milestones, more institutions become interested. So like I think 100 million is a big one, that like a billion's like a massive one. So I think that ratio might change, but I'd say it's like primarily retail right now with liquid funds and whales, and then some institutional interests.
Maybe to finish off, we should take another small detour into the GS token. So what it essentially does, if I understood it correctly, it entitles you to 30% of protocol revenues when you stake it. How does that get paid out, and how does yield generally get paid out if you're active on GammaSwap?
So yeah, there. It's a good question. So yeah, there's different types of depends where the type of product you're interacting with. So if you're providing liquidity in a pool, let's say it's ETH USDC, the fees you earn from providing liquidity are compounded back into your LP position, like Uniswap V2. If there are rewards that are earned, they're in the escrow GS token, which you could stake, and how the yield is received from staking is the same if you stake GS or escrow GS. It's 30% of protocol revenue provided in ETH, and then multiplier points. So the longer you stake, the more percent of that protocol revenue you'll earn in ETH, and then some escrow GS rewards. And then that depends on the chain. So I think, for example, since we launched a yield token on Base, the staking fee APR is slightly, I think it's actually significantly higher there than Arbitrum, but we're going to launch more on Arbitrum. So that's an example of, I guess, something to think about and look out for too, is that it's chain specific. And then, so that's the pools. Then if you're borrowing liquidity, you can use one token of the pool as collateral and as your payout token. So if it's an ETH USDC pool, you can use ETH as a collateral and get paid out in ETH or USDC in just one token. And then the yield tokens you would earn, uh, you can think of it as like wrap staked ETH. So it should increase, wrap staked ETH should increase in price over time. So you can collect more ETH from it in the future. And then that's how you're earning the yield from the yield tokens, is that vault token is being compounded over time by increasing in price from the fees.
Hmm. Another interesting note is that you launched your new Vault product on Base and not on ETH mainnet. Is there any specific reasoning to it? Especially because I think over 2024 and most part of 2025, there has been a very strong concentration of new DeFi products around the ETH layer 1, and ETH layer 2s have sort of taken a backseat there.
Yeah, it's a good question. I mean, I think Ethereum has more liquidity, but Aerodrome has done really well on Base, and that's a partner we want to potentially integrate further. The yields on the L2s are higher, and some of the pools actually in Arbitrum are getting competitive with Ethereum. And then also we're doing rebalancing right now with our custom price aggregator, and we didn't want to worry about MEV. So we still think it could work on Ethereum, but it would just be safer to launch on the L2s. So we did that first. And then yeah, we're gonna eventually move to Ethereum when we feel like the strategy is in a strong point, and then also where we wouldn't have any MEV issues. We're worrying about rebalancing. I think that's like one benefit of the L2s is not having like that mempool.
I think also for scalability and just if you have a high frequency of shifting things around, deploying
Yeah,
L2s is still efficient.
the gas costs could be an issue. Luckily, Gwei on Ethereum has been lower. And then if the vault is not, if it's a liquid vault, so if it's using some pools that are liquid, it's marginal compared to the total cost of the vault. It's not something we would be doing like every hour. Like I think with the current strategy, we predict rebalances to happen at most like monthly, depending on the volatility. And even if we tightened it, maybe it's every couple weeks, which if you have a couple million in the vault, the gas cost is probably not going to do everything crazy. I guess that's another thing I could add is that we don't process withdrawals and deposits every instant. Right now we're doing it daily, and could change the frequency, but that's something that saves the gas cost. So something like if we were to launch on Ethereum, we might do like weekly or something, and then the gas costs become pretty marginal because we'd only have to process all those deposits and withdrawals weekly, and it would be in one transaction.
Yeah, I think that makes a lot of sense. Is there any other topic in and around GammaSwap you'd like to cover, or anything else you're personally passionate about in DeFi and beyond?
Yeah, I mean, I think we talked about Pendle a little bit, and I mentioned some of the capital efficiency with Boros, but I think Pendle is doing really interesting things right now. I think they're V2. You know, they grew that to become a very successful version of their protocol. And with Boros, to me, it just seems like, yeah, I think a lot of the products that have done well this cycle have actually been bringing like off-chain yields on-chain. Like Athena is a great example there. So I think this is Boros's way of doing that and capturing some of that yield that has been inaccessible in DeFi, like on-chain, and then allowing more people to hedge and stuff. So that's one product I'm really excited about. And yeah, one thing I like about Pendle is that these products are very complex and interesting, and they're always super innovative. So I always like respect builders trying to do something like new or different. And then yeah, I think there's been a lot of innovation in DeFi still continuing. So there's lots of other protocols working on interesting things. One we talked to recently was like P-Pods doing like a different type of like volatility farming, which is interesting. Different new types of like lending markets. Yeah, I think it's a really interesting time to be in DeFi now with like the Genius Act coming through and finally getting some support. I'm based in the U.S., so it's really nice to see some support from the U.S. on this. It's always kind of surprised me that the U.S. hasn't supported, but I'm glad they're finally like doubling down on it. I think we're going to see a lot of growth in stablecoins probably first, but I think it's just going to really allow like the floodgates open for institutions. Like now with 401ks allowing to invest in crypto and all these other things, there's just going to be a lot of opportunities, I think. And then I think we're going to get, some of these like wealth managers coming into the space too, because you have higher appreciating assets that earn more yield. I mean, it's kind of a no-brainer, at least to have a partial allocation in this industry. So to me, like the future is really bright. And yeah, we just are focused on making our products more useful and more scalable. But I think there could be there's going to continue to be lots of different types of like products that will succeed in the future.
Very nice. I agree on a lot of these points. I think 2025 has been a great year of DeFi innovation. And I mean, that has been preceded by last year where many of these things have been set up and been initiated. If you look at Pendle, if you look at Fluid, stuff like Hyperliquid, the UX is now competitive with centralized applications. a lot of fundamental finance primitives like interest rate derivatives, etc., have come onto DeFi. Capital efficiency is getting addressed by stuff like Fluid 2. You have more diversity on the landing landscape that caters to different risk and yield profiles with Morpho and Euler right now. Then you have tranching and duration coming into the mix with Infinify and Mezzanine Fi, what is going to launch in a few months. So yeah, I think we are ahead for some pretty exciting times. And if you just look at the macro landscape, I mean, where else does capital want to go besides crypto? There's a little bit of AI and robotics stuff going on, but yeah, I mean, you don't really have a major alternative to risk assets right now, and it doesn't seem like any of that is going to change soon.
Yeah.
So I think we can be pretty optimistic what is going to happen to our industry in the coming 2 to 3 years.
Yeah, I totally agree with you. And some of those, I kind of had a brain fart, so I forgot about some of those protocols. But I think Fluid's really interesting. I think you're going to see like more protocols kind of combining like what we consider like separate major categories in DeFi into one. So like for them, it's like DEX and lending. We're kind of combining DEX and lending too, but in a completely different way. So I think you're going to see more of that happen. Infinify is really interesting with the tranching and mezzanine as well. That's just something that's existed TradFi for a while, and it's a really, I think it's like people have been thinking about how to do credit in DeFi, and so there's like the classic credit, which I think like 3Jane is working on. But I think like if you want to be just totally crypto native and not do any KYC, then I think something like Infinify makes sense because you get credit based on like a duration essentially. So I think that's and creating leverage that way. So I think that's a really interesting approach. And then yeah, there's I think there's going to continue to be like interesting things being worked on, and especially like AI. I think AI is really interesting with crypto because uh, regardless of, I guess, you know, I think everyone is excited for where crypto can go and sorry, AI can go, and regardless of like the pace you think that could happen, like there's definitely going to be agents that are out there, right? And these agents are not going to be opening up a bank account because they don't have an identity. Like crypto is going to be their native money, and the only way they're going to be able to like interact with humans, accumulate assets, even if regulation passes. I mean, it's just much more efficient for an AI agent to work with crypto than it is to work in the traditional industry. So I think it's naturally, yeah, like gonna grow a lot with AI, and I think these AI protocols are a lot of their infrastructure. If it's like a financial AI component, is gonna have to be based on crypto. So I think that's a really exciting like development in terms of like kind of like new, I guess one way to think about like new users for crypto that it'll work really well with.
100%. I think we are increasing the likelihood of this industry winning day by day. It remains another question whether all the value accrual and capital appreciation will happen in crypto native applications and like crypto native assets. I think stablecoins were a good example where traditional finance was very excited about this entire industry maturing, but the main profiteur of stablecoins taking off was the Circle stock. I mean, it has given up or given back a lot of its prior gains, but the price appreciation of DeFi native stablecoin plays was very muted during the Circle run up. I think we are catching up a little bit on this lag
Yeah,
right now and during the past couple of days with Ifina appreciating again. And yeah, I do think that this is going to be an interesting challenge going forward, whether we will be able to capture the introduction of these new technologies on the value side within crypto, or if distribution that is existing on the traditional finance side but not in our industry is so disproportionately important that they will essentially have all the negotiating power over the underlying tech. But yeah, it was amazing having you on, and I think we covered a lot of things regarding GammaSwap and DeFi in general, and the evolution and development of liquidity providing tools and impermanent loss. So, where can people find you? What should people check out on GammaSwap? And yeah, how can they learn more?
Yeah, so our Twitter is at GammaSwap Labs. And then our Discord's in our Twitter bio, but it's discord.gg/GammaSwap Labs. So that's where you can find us. And yeah, if you want to learn more about the protocol, our academy is a great way to start. So that's just linked on our landing page, gammaswap.com. And if you ever have any questions, you can always ask them in our Discord, and our team will get back to you shortly. So that's probably the best way to get started.
Very nice. Any last comments? Any last words?
No, I mean, thank you for having me on, Max, and then thank you for anyone who listens to this. Really appreciate everyone taking their time.
Very nice. Was great having you on, and yeah, let's stay in touch, and maybe we'll set up a roundtable for everything regarding LP tools and LP solutions, and get some spicy debates going on there.
Perfect. Would love that. Thank you again.
Have a good one.
See you later.